Hello and welcome back for another edition of London Direct. There's been a couple of really interesting data releases over the last 24 hours or so. First of all, we had housing stats which showed that house prices just keep on getting stronger and stronger here in the UK. So are they heading towards bubble territory? Also, we had inflation data coming less strong than expected. Well, I've been speaking to Ishaq Siddiqi from ETX Capital about these topics. Let's start by talking about the CPI data. It came in a lot weaker than many were expecting. What does that mean for the Bank of England?
I think it's good news for the Bank of England, not enough to get too excited just yet. I think they're going to be quite conservative with their inflation forecast. Inflation is very likely to creep higher. I think we have to factor in the fact that this has the one-off exceptionals of the fact that we are seeing lower fuel prices and retailers have reflected that on. At the same time, the university tuition fees, which were lower than they were previously. So when you have to look at these figures, I think you've got to take a bit of prudence on them. You can't get too excited. I think that's going to be reflected by the inflation report tomorrow. Very unlikely they're going to adjust it. I think they're going to hammer home their forward guidance message. Perhaps put more emphasis this time around on the unemployment rate, which is currently at 7.7%, and again suggesting that they're only really going to start tightening monetary policy after it dips below the 7% mark, and even then they'll still watch them. I think now the market is also expecting the Bank of England to delay any sort of tightening of monetary policies.
Yeah, sure. I mean, let's just talk about this whole tightening story. Yep. We've seen analysts get very excited and get it very wrong recently with Sep taper. Also, with the ECB's rate cut last week, it wasn't really seen. Doesn't it surprise you that people get so carried away with these things? Because if we take the Bank of England as an example, they're only going to start tightening monetary policy when things are exactly right, because there's no second chance with this.
Absolutely. I think the market has been too obsessed by second guessing central banks, and interestingly central banks have now changed their language in order to let the market understand what they're doing a lot more clearly than before. But even then, that doesn't stop the market from second guessing the central banks. And I think the big reason behind that is the fact that there's been huge bouts of liquidity pumped into the global market system, and markets are extremely reliant on this sort of liquidity. So if they don't put themselves in a position where they can at least get some sort of idea of what the central banks are doing, then they're going to have to be contending with less liquidity, and that's not going to be a very favorable environment. So I don't think that's going to stop. I think we're going to continue doing so. Now it's all about if we're going to see December tapering by the Federal Reserve, are we going to see further interest rate cuts by the ECB? I think the ECB's cut last week was somewhat symbolic, less suggestive of what's going on in the Eurozone. They do reckon that we may see a threat of deflation similar to Japan, but I think that's way off right now, and it's just really the ECB's way to stimulate growth. And again, with the Bank of England, it's very unlikely that they're going to change their monetary policies going forward, and I think they're going to stick to that until at least late 2016 when those thresholds come into play.
Yeah, I just want to finish off by talking about this these housing stats from RICS. I can see both sides of the argument. It's easy to say that there's a bubble forming, especially in the southeast of England. But the other side to that is that demand for housing has always been very high in this country, simply because there's not enough houses, which is far from an ideal situation. What's your take on the latest stats from RICS, specifically because they showed that house price growth in the southeast of England was something like 10%?
Yeah, over 10% in southeast England. Interesting, the figures that I found quite interesting for me was that the average price in house price in London, or in Greater London, is over £400,000, and in the Kensington and Chelsea area over £1.1 million. So yeah, I suppose you can say ridiculously inflated house prices puts a lot of first-time buyers out of the game to actually get a mortgage to buy houses. There is a bubble forming on the top there. We could see a collapse of the housing market, possibly not yet, but maybe there's some time to go before we do see something like that. I think that's going to go into the Bank of England's thinking later on. We do have government initiatives such as the Help to Buy scheme, which is somewhat controversial now. I think it's just a story to watch. We've had a lot of news news from the housing market this year, particularly with Foxton's IPO earlier, around the summertime, clearly suggestive of the fact that the London property market is gaining on a, I would say, a ridiculous level. And I think London has to be counted as an isolated case, and it's a problem for Londoners, not so much for everybody else around the country, where we are seeing housing prices at moderate levels.
Well, thank you to Ishaq. Coming up, we'll take a look at the FTSE. I just want to start by talking about the housing data. I've just been speaking to Ishaq about it. But in terms of an equities point of view, is there a play here, just buy the UK house builders and put your feet up and just watch them go up?
There is. Obviously, there are risks that the bubble that everyone's talking about will burst. But the housing sector has been pretty phenomenal. It's helped sort of drive the rise that we've seen in the FTSE. So there is a little bit of that, but there is a bit of caution that if the bubble does burst, these house stocks, as they're known, will fall pretty sharply. So just be aware.
But there's no sign immediately. Do you think that this, if we call it a bubble, that this uptick in house prices is going to end anytime soon? Is it?
Well, that's not what they were saying in 2008 as well. It could happen. I mean, there was talk of the supply of houses is pretty limited. It's never a good sign. I mean, the number of mortgages, I think, was on the up, which is always good. But there is a chance that the bubble could burst. There always is a chance the bubble could burst. So they do need to be a little bit cautious.
This is partly a very lazy question, but I'm starting to read more and more about the Santa rally. Those two words. It's depressing enough that Christmas is getting that close already. But historically, do we actually see the Santa rally, and is there actually enough to be optimistic about to have a Santa rally?
I think there is. Certainly in the UK, we've seen some pretty good economic numbers coming out. There was even talk that perhaps we might even see an interest rate rise, certainly earlier than expected, because of the fact that the economy seems to be on a more stable footing. As for the Santa rally, I never believe in things like that. Volumes do dry up towards Christmas, and that can exacerbate any move. But I mean, as for a rally, I think it's sort of we seem to be ending the year as we started off, and the markets are pretty strong.
So where do you think we will end the year? Closer to 7,000 or closer to 6.5?
I think closer to 7,000. To be honest with you, there doesn't seem to be anything stopping this. And every time we do see a dip, which we've seen in the last sort of week or so, the market then seems to pick itself up and rally up to new highs, as we're seeing in the US, and we're getting pretty close back again in the FTSE as well.
Well, thanks to the guys at ETX Capital. It's always a pleasure. So for now, goodbye.